Hello everybody. I've been away for a few days looking at recycling plants. Incredible places. Anyway, I'm back and so's the market. Now, I've spoken earlier about this to say that there's a liquidity squeeze going on because of the American government closure and reopening and issues with the Fed and their change from tightening to not tightening. So basically a disruption of liquidity coming out of the US. And that is what wobbled the market. That's what made it kind of correct. I mean, it's pretty minor really. When you actually look at the chart, you see didn't really correct that much. But these days with a market that just goes up and makes everybody wealthy, any sort of pullback makes everybody extremely nervous because, you know, they've had it so good. A little bit of a wobble scares the daylights out of them. But anyway, I said at the time this would pan out because, you know, the US government is on the ball when it comes to market crashes, and they kind of navigate by the market trend. They know they're putting enough money into the market to keep the economy going if the market goes up. And if you think about it, government people have all their money in two things: their property and their stocks. In America anyway, not the same in the UK. So they will not let them falter by much. So not only is it what they navigate by, it's where their skin is in the game. So it's a double indemnity. So what I expected to happen was that they would pull the print lever, and if that wasn't enough, they'd pull it again, and they would print, control P, as the wags say. And they've controlled P, and they've controlled P, and they've controlled P, and now the market is back on track, or actually is recovering to that long-term trend line. So if you want to see that long-term trend line, here it comes. Here it is now. So see that? I mean, you know, it really couldn't be much smoother in a world that isn't that smooth. And if you want to go back further and just simplify the whole situation down, here's a really long-term chart. Look at that. Why would you even worry? Now, obviously, the market's going to crash because the market always crashes, and it always will crash. And we try to avoid the crashes, and hopefully I'll avoid them like I have most of them in the past. In fact, I don't think I've got hit by a crash since 2002. Because that can happen, and it's always good to get out before a crash and get back in after a crash. There's a lot of money to be made there. But if you just did what they say in the books to do, buy an index fund, buy and hold a DCA into it, don't worry about it, just, you know, buy the spider and pay no attention, you do pretty well. In fact, you do really, really well. We're trying to beat that, and I believe we can, although the theory says we can't. But I think I've done a pretty good impression of being very lucky over quite a long period of time in beating it. And that's what we're trying to do. But the fundamental point is the market's going up. And it's been going up for a very, very long time. And in fact, I could probably pull a 100-year chart and it will look like it's going up. And, you know, 1929 won't look so big. Although, having said that, 1929, the market didn't recover to 1954. So we try to avoid those things. And if you bought at the bottom in 1932, by 1937, you're doing really well. So yes, that is step two. But step one is, which way is the market going? And the answer is, it's going up. And there will be lumps and there will be bumps. And one tries to, you know, duck and dive and bob and weave a little bit to minimize the downside and maximize the upside. And also look out for those crashes. So 2008, beginning of the year, that sort of thing, and they come along every 3 or 4 years. But overall, there's only one question to ask: which way is the market going? And the answer is, it's going up, and it's going up long term. And so we are trying to beat the 7%. We're trying to do the 12%, the 15%, and if we could do incredibly well and push the really the ultimate barrier, the ultimate limit of what you can get in a year, which is about 20 to 25%. So that's our target. But after this wobble and after this shake, the idea to take away from it is that unless it's something absolutely massive, a plague, or a complete financial default, or a massive bubble crash, then the market's going to go up. Now, I think we will have a bubble and a crash, probably 2 to 3 years, and it will be in the NASDAQ, and we'll be able to watch the NASDAQ. And when it goes into the bubble mode, which is probably just about to go into, if it hasn't already done a little bit, it will be in the bubble mode, and that bubble mode will last a year, 18 months probably, and then there will be a crash, and then hopefully we'll avoid it. And that's also the game that we're playing. So the takeaway from this is that we are going to have a continued bull market with lumps and bumps in it. So unless there's something really big happening, don't worry about the lumps and bumps. Just sit back and enjoy the ride. Anyway, I hope this is helpful. Thank you very much for watching. To all my members, thank you very much for being members. And you can read more of my material on Substack and on Forbes. And I'll be back in a day or two. See you then. Bye now.